And joining us right now to talk about that is Liz Young. She's the head of investment strategy at SoFi. Also, Kevin Nicholson, who's global fixed income co-CIO at Riverfront Investment Group. Welcome to both of you. Some big looming things out there. Maybe front and center is the potential for a government shutdown on Friday. Kevin, what do you think happens ahead of that? Are people nervous? Are investors nervous looking at bonds at that point? Do they actually think that this would be a situation where things shut down? Will that have an impact?
You know, there's a possibility that we get a shutdown. I mean, it's happened a lot, over the last, 10 years or so. But one of the things that I think that the market is really focused on is whether or not we get this deal done in a timely manner. From a fixed income standpoint, we're at
avoiding the shutdown, or you mean the bigger spending deal?
I think it's the bigger spending deal. Having the market shut down or having the government shut down is one of those things that will be very short-lived. The big issue is whether or not we default on our debt, and which we don't think that that's going to happen. And we think that there will be an 11th hour agreement. However, I think the markets will be focused on it just because we're coming into the end of the quarter and the markets are still a little bit jittery, even though we've turned to risk on.
Liz, you think that people should still buy the dips at this point? So if there are some jitters around any of this, would that be a situation where you'd say kind of jump right in?
Yeah, well, I think Kevin's right that even if there are jitters, it's a temporary situation. And the reason that I think it's going to be temporary is that although we're out of the crisis, I think we're at a point where economic growth is still a little bit more fragile than we'd prefer it to be. And the government knows that. And I hope that they wouldn't create any unnecessary risk by shutting down and bumping up against a debt ceiling that would give us a lot of jitters. But as far as buying the dips, what I mean by that is I want people to be specific about it. So it's not just about buying the dips in a broad index. It's about buying the dips in the themes that you think are going to lead going forward. So things like real rates rising, which is financials, things like playing offense on inflation, which is materials, commodities, energy, small caps, and things like government spending that should go into effect if and when we get this package through. And you would play offense on things like healthcare. You can look at clean energy and some of those themes that I think going forward are going to be more opportunistic. You know,
materials and energy, some of those have dipped recently because of concerns about the Chinese economy. You don't think you should be buying the dips in China, correct?
I don't think you should buy the dips in China. I think there's too much uncertainty over there still. I've said this before. I don't think the juice is worth the squeeze at this point. And China just continues to surprise us with either another crisis or another announcement about regulation that hurts the market. So I'm not ready to buy dips in China.
But if China has those concerns and issues with its own economy, you don't think that bleeds over into the broader global economy? And that's why I asked specifically on things like materials and energy, because it seems to me that those dips have been predicated on this idea that a problem with the Chinese economy is going to lead to bigger problems for the global economy.
Sure. So the concerns really have been that if there's a problem in the Chinese economy, it's going to hurt demand for things like energy and materials, and that's what's been the things that are pressuring prices. I think that the Evergrande crisis is something separate as well, where it's not a non-event, but it's been contained to China. So there hasn't been contagion, and that fear about contagion has been contained. As far as demand goes, I think once the world gets back to normal, or whatever we consider normal, there's plenty of demand to be had from the United States and from Europe. There's still a lot of money in savings, and I think that we can pick up that demand that's lacking in China.
Perfect. Kevin, you are still telling people that they should be underweight fixed income. You heard what Jay Powell said last week. The market is kind of anticipating that this taper will begin, but it will be slow. What do you think happens next?
Well, when I look at the fixed income markets right now, 145 was overhead resistance as we saw it. And we've actually broken through that this morning. And I think if we get a continuation, we'll see rates that will go into the 1.5 to 1 3/4 by year end. Everyone has been really focused on whether or not the liftoff, how fast we were going to have liftoff. We believe now liftoff is going to come probably towards the end of next year. So people still have time. Investors are going to be looking a lot at what happens as far as how fast rates creep up. And at this point, we think there is going to be pretty well managed. from that standpoint. So we don't see any reason for fixed income investors to jump into the markets right now. We believe that you need to stay underweight fixed income, keep duration short on the shorter end, because we think that the longer end of the curve will be rising over the next, 6 to 8 months.
Kevin, Liz, good to see both of you.